SMSF, the first word is self. You want to do more things with your money.
The non-bank space in general is going to start to flourish.
It's like a back of the napkin.
Beautiful house.
What you can already see from this drawing, by the way, is Jack should not be in architecture or design.
Hang on, mate. The houses didn't have a window, didn't have a chimney. The door's a bit crooked. Doesn't matter, mate. But don't worry about the dog's breakfast of handwriting. All of these scenarios, they're 80 and 70% LVR.
Really taking you to the finish line, your long-term wealth strategy from an income point of view. If they're not going to perform well, that contribution could have been growing your balances and it's wasted. What sort of household income do you need to be on?
I wish it was a simple answer, mate.
What's the answer?
But it's not.
Give it to me.
Because it really depends on a lot of things.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
We're back for another episode of the Property Nerds, and by popular demand, it's all talk on SMSF. But this time, instead of SMSF as a topic, setting it up, actually using it, we're talking lending side. Because when we talk lending, it'll just help unlock a lot more thinking around what the dollars can do, how much the ins and outs are, and what's possible in SMSF. So if you're tuning into this episode and you're wondering, how much could I potentially borrow in SMSF? What are the numbers and the ins and outs look like in SMSF? Residential versus commercial? Then you want to stay to the end of this episode because, again, we're doing another whiteboard special with Fouracre. Right. Is that the name of it? The Fouracre whiteboard special?
We'll have to figure something out. We'll figure something out.
We've got to call this. This is the second time we're doing this, having some good fun. And if you're listening to this on Spotify, SoundCloud, Apple Podcasts, or anything like that, and you want to jump in, you want to watch Jack talk through his magic on the whiteboard, jump on our YouTube channel, Investigate, and subscribe for more videos that are to do with property notes, but also just overall, we cover off a lot of other content on there too. So Jack, let's talk SMSF, and particularly, I want to understand some of the new policies in, because the SMSF world keeps changing for two reasons. It's getting really popular, and two, as banks fight in that popularity, the competition creates more fight for their business. So what's changing? What's happening in SMSF of late for lending?
Yeah, well, there's more lenders coming into the space. We've talked about it previously about lenders getting out of trust lending and stuff like that, which means that the non-bank space in general, even outside SMSF, is going to start to flourish, right? Even more than it already is. But that's going to have some flow-on effects to the SMSF space because those non-bank lenders that come into the space to compete, they quite often offer SMSF products. So it's going to get more competitive, which means that the rates are going to get cheaper over time. So it's all good news. Keen to dive into it. There's a promotion at the moment where you can do 90% LVR without any risk fees or LMI, which is really good.
Wow, LMI waivers come into the world of SMSF.
Yeah. So traditionally at 90%, you're looking at like 3.5% as a risk fee on the purchase price. And then 2.5% at 85%.
Yeah.
So it's significant, like as a cost just to enter. So the fact that that's waived at 90% is great. So it's not like it's just.
Is it profession dependent or anything like that?
No. You got money in your super, you can borrow. They're good to go. But it's not something that we do very often because it's not like you necessarily need to do a 90% loan for most cases. Like most people that are even interested in SMSF. It's a couple, they've got household income of 160,000 or something like that. They've got a decent balance anyway, and it's unnecessary to go to 90% because if they're not charging you LMI or a risk fee, then they're going to make it back on the rate. So it is a high rate, but you could refinance it at 80% with a better rate within a year or so. So it's a good short-term option for some people that either want to be really aggressive and stretch out their funds to get a second purchase after just putting a small deposit down for the first one, or for people that have a low balance but really high income that just want to maximize the leverage on their first property in super.
True, that's a big one because sometimes people, like give an example, people move to Australia in their 30s or 40s. They get high-paying jobs when they come in, they become PRs and citizens. But even with those high-paying jobs, their super balances might not be very high. And so as a result, they're able to then get into investing because of these lower deposit, high loan-to-value ratio. Because I've seen some interesting scenarios. I've seen some people in their 40s, a couple, earning 200 each in IT and different parts of roles. They've moved over from the Northern Hemisphere and they come from many different countries and they come here with the specialized skills and then working here. But then their super's like 150K between them. And you're like, Interesting.
That's a really common
perfect example, right?
Yeah, definitely. Yeah, we definitely see that. And they've even done that and paid the risk fees because they know they've got significant servicing. They're just really restricted by the deposit, but they want to be aggressive and they want to go into it. That's a perfect example for someone who could benefit from that.
Got it. Now, that's one core new policy, which is a big one in the SMSF space. Basically, LMI waivers for all, if you can service it and if it makes sense. Are there any other new things that have come out to the world of SMSF of late when it comes to policies or things like that? I know there's some things in the commercial property world when it comes to loan to value ratios that you see. What's happening there?
More and more lenders going up to 80% LVR for commercial securities, which, you know, hasn't been, if you think back to 5 years ago when podcasting was like pretty new for property and it was just popping up everywhere.
Yeah.
When they're talking about commercial and things like that, you know, you'd get excited at a 75% LVR. And you think, whoa, what's going on? But then it'll be a 15-year loan term.
Yeah.
You know, to think that in super, you can get an 80% LVR and a 30-year loan term. It's just, you know, best case scenario for people that really want to leverage into a commercial asset like that.
And when you think of people getting into that, it's like, okay, firstly, commercial is the end game from a portfolio.
Yeah.
Like commercial or other asset classes.
Yeah.
That's the end game. Like very rarely is debt-free residential, unless you're cool with a smaller passive income and smaller usage of the value base, going to get you the dream passive income you're after.
Definitely not.
So when you know that you can now get high leverage for it, you can get into a vehicle that's quite tax effective. It starts to make a lot of sense. Can we jump onto the whiteboard Fouracre special?
Go, man. Let's go.
And can you take us through the commercial side?
I think we should start with the residential side.
Okay, let's go residential.
Just because
done.
most people are going to start residential and then end up to commercial. So we'll start with the residential scenario that we've done up. Sorry about the wheels.
And are we covering with residential, like, actually, this is a good point. So what we're covering off here for those watching and for those listening in, don't forget to jump onto InvestorKit YouTube channel and check this out. But Jack, what we're jumping on here is giving someone almost like a back of the napkin borrowing capacity and funds to complete type scenario for if they're purchasing a commercial property. And what you can already see from this drawing, by the way, is Jack should not be in architecture or design.
Hang on, mate. If anyone saw the last episode, the houses didn't have a window, didn't have a chimney.
True. If you haven't seen
some significant renovations, all right?
You've made some renovations, but your windows are tilting. Your windows are
different
odd
sizes.
size.
The door's a bit crooked. Doesn't matter, mate.
You know, it's crazy. Everyone universally was taught that house drawing up when they were kids. If you're born in the 90s, every house that your 90s kids and stuff, like, no,
I know
it was
windows
that.
at the bottom, though.
Yeah.
Like, I don't know. What's going on there?
Tune into our podcast for real-life case studies, the latest data, and even expert guidance on residential and commercial investing. It's everything you need to stay sharp, straight from the field. Make sure to like and subscribe to get insights that only we have. And now let's get back into the show.
But anyway, like, I thought we'd start with the residential scenario because most people, when they're going into super, start residential, right?
Yeah.
And then they use the growth in the residential to get another one, and they eventually, close to retirement, they sell off the residential portfolio and enter into super. So we'll go into the commercial side after this, but just working off a 600K residential property, funds to complete with buyer's agent fee and everything like that, you're looking at about 165,000 as a combined balance between the household.
And that's why
individual.
also on that number 165, it's why it's so common to hear people when you say set up an SMSF or you're going to think about doing that, have that balance of 175 to 200 plus because it covers that scenario plus leaves a bit of cash on top.
Yes, a little bit of a buffer, not that you need it for your first property because if we go just break down the numbers, I mean, this is for an 80% loan on a 600K property. So to service it, you just have to have a household income of $170,000. The super contributions at 12% on that is $20,400, and a 4% rent on a 600K. Very conservative, just to not try to make the numbers look too good. But the money going into the super with the rent and the super contributions combined are $44,400. Now the repayments on 80% interest only, $33,552. So there's about 11 grand there to make up for repairs and maintenance, auditing fees, and things like that. So it's more than enough to cover it. And you're not going to need a significant cash buffer in this case for your first one. Once you start getting your second residential or your third residential, then you've got to start to think about, okay, well, the risk is definitely high. You want to have a bit of liquidity in the fund. Not that the lender needs liquidity, it's just good to have it just as a bit of a safety net. But Yeah, that's a beautiful house. We might have to make a double story next time.
Well, firstly, it just shows you though that your contributions of 20K, your rent of 24K, that's what, 44K. It's covering the repayments. And look, yes, there's council rates, water, insurance, but even then it's covering that.
Yeah.
Now, is that interest-only repayments?
That's interest only.
Interest-only, right. So it's still going to be positive gearing if you think of contributions, but this is why it's also, when you think of contributions involved, this is why it's also so important to make sure though that your properties you select are held long-term and perform well.
Yeah.
Because if they're not going to perform well, that contribution could have been growing your balances and it's wasted. So it's so important to have the right team there.
I just wanted to put this down as like a base level, entry level, what you could actually do as a base level. So if you fit that description of 165 combined super, which most people thinking about this do, and a combined household income of 170K, which is very achievable with a lot of the clients that we work with, this is a relatively entry level type security. That's not like 600K is a solid purchase price as an entry level. So obviously these numbers would vary dependent on other factors, but yeah, I think it's a good example to start with before we jump into the big stuff.
All right, residential makes sense in terms of back of the napkin, 170K household income, 165 funds to complete in super, and then those numbers at a baseline gets you that 600K property and a bit of buffer left over and covers it from servicing. So it just gives you something to deal with. Now, as Jack's going over to the commercial scenario, the key thing to note here is that even as you go into super, the borrowing capacity is separate from personal borrowing capacity than it is in super. So you could have 1, 3, 4, 5 properties personally. The superannuation capacity there was the capacity that's different to personal.
Just on that, that is true for the most part, all right? But there are certain circumstances where if the lender that you're using with the super is the same as a lender that you're using outside of super, then that could clash.
Got it.
But basically, most lenders don't ask for it, but if they do, they just want to know that the rent and your contributions are covering the repayments and that it's not, you personally aren't required to put additional contributions into the fund to service it.
Yeah, and which is why the household income number is important, because technically the contributions of the household income would go towards it, right?
That's right. And we're not using that for servicing outside super.
Absolutely.
Anyway,
Absolutely. Now, we're on to the commercial part, but before we go into the commercial part, when we're showing you these residential and commercial scenarios, it's important to note that it's not from a perspective of like, this is advice of what you should go and do. This is just us going through general numbers that we see quite often as professionals in the space that we're in, and so people can see what it just looks like. Doesn't mean we're saying you should go purchase property using super, or you should even set up a super, speak to a qualified licensed financial professional when you're making that decision. So this next scenario, Jack, we're talking commercial, and this big thing is off the back of the things that you mentioned earlier, which is commercial was so common back in the days, 5-6 years ago, 60-70% loan to value ratio, which meant very cash heavy. And then we also know that commercial is a big end vehicle, and so people with the right super balances who want to consider commercial in the mix of their portfolio, not only do you have it in a tax-effective vehicle because it's less tax rates in super than it is outside of super, but then you also have your contributions, a high level of rent, and in this case, potentially 80% loan-to-value ratios if you can service it, really taking you to the finish line of your long-term wealth strategy from an income point of view.
Yeah. So don't worry about the dog's breakfast of handwriting.
Hey man, it's better than mine.
There's no pictures, eh? We're
no,
gonna have
no
to get
pictures.
some pictures
No pictures
incorporated into this next time. But we've got purchase prices here, funds to complete requirement there, repayments and yield outcomes here. So just got 2 million, 2.5 million and 3 million. So just on the 2 million purchase price on a commercial, the funds to complete at a 80% LVR is 480,000, not including buyer's agent fee. And at 70%, you're at about 680,000 funds to complete.
Yeah.
Now on a 80% scenario, the repayments interest only about just under 120 grand, and for 70%, it's at around 90 grand. So a 6% yield on a $2 million purchase, net 120,000. So that's covering itself. The rent is covering the repayments, and we're not even talking about contributions. Like,
this is interesting. So what we're basically saying is if you have the surplus super balances and you're in that 680 plus, of course, you can have that 30% down and be positive cash flow from the get-go on interest only in a tax-effective environment.
Yeah.
But if you did use the funds to 80% to get the power of leverage, to get into commercial property earlier, you're controlling a $2 million asset, and at a 6% net yield on that commercial property, you're covering the interest rates and the interest-only loan on a $2 million purchase price at 80% loan.
Yeah.
So it just shows you that, like, even if you did stretch the loan-to-value ratio up, which is more common now in SMSF, to 80%, you could still get coverage, and your contributions left to the side can grow the fund, but you're controlling a $2 million asset.
Yeah, and we've had some high-income professionals go straight into that without even going into residential. They just go commercial straight off the bat. They're like, look, I've got $500,000 in super, really high income earning. The rent covers the repayments, which means that their super contributions just go directly into the fund and build up faster than if it was a residential. And they basically can generate another deposit for a smaller residential to, again, have exposure to capital growth and eventually sell that to pay off the debt or sell it to buy something bigger. But it's much the same when you go down to 2.5 mil, 600K funds are complete at 80%, 850K at 70%, 150,000 repayments at 80%, 150,000 6% net yield.
So the theme still continues at 80% loan to value ratio. As you increase the purchase prices, as you increase the yields, you're still going to get coverage from the rent in comparison to interest on today's rates.
That's right. And that's the same for a $3 million purchase. Obviously, the funds requirement goes up, but the rent also goes up and covers
rents
the
can
repayments.
go up, contributions not factored. And look, I know interest rates can go up or down, but potentially could go down.
That's right.
And then all of a sudden, you're like, I had, in that third scenario, $3 million purchase price, you put down almost $300,000 less as a contribution. Just to get a holding of that $3 million asset, like, which is pretty wild.
Yeah, but like rents, like you said, rents are going to go up with the commercial lease. So, I mean, all of these scenarios, they're 80 and 70% LVR, right? So for the average mum and dad investor that have a modest household income from modest beginnings that just start with a little old balance, go and buy their first residential property, these LVRs aren't in the future, right? The strategy for people like that would be to, buy their first residential one, look at getting a second one, potentially a third. When they're closer to retirement, selling off all of those residential assets and then going into a commercial asset like this, but at a much lower LVR because they've got a huge deposit that they've generated. But their borrowing powers would be really good because the rent's still really strong, but you only need to borrow like 50% on the property. So
now I might put you on the spot for this next question. Obviously, we have started seeing a few more customers as well, and we've always had them, but like much more in quantity of late with balances where like $600K to $1 million in supers is common. And where they start having these balances as a couple, obviously having the balance, the purchase price, and the rent. These are three things that are tick. Because purchase price is there, we know we can get deals in that area, they have the balance, they have the net yield. But when you're talking household income from contributions, because obviously the banks don't just rely on the rent of the property, they also want to look at your contributions.
Yeah.
What sort of household income do you need to be on to be able to take a $3 million commercial purchase? Say they've got the $1 million in super.
Yeah.
They've got $720 they want to use towards it, like 80%.
Yep.
They can clearly cover the rent with the interest at 180 passive income from the rent for 178 of interest. So it's covering itself.
I wish it was a simple answer, mate.
What's the answer?
But it's not.
Give it to me.
Because it really depends on a lot of things.
Yeah.
So there's a big group of lenders that are really common in that 80% space that would cap the amount of super contributions that you could use for the purposes of servicing to $30K per client.
Got it.
Right? So once you get above that, there's options to look at your servicing outside of super to see if you've got capacity outside of super to make additional contributions. Because they're not looking at actual rent, actual repayments. They're looking at shaded rent, assessment rate on the repayments. So although it might be positive, even on 80%, they're not looking at that. Once they add in the buffers and the assessment rates, it's going to be negative. So once you cap out at that 30K, they can look at your personal assets and liabilities to see if there's additional contributions there. And if you're a really high income earner, should be able to make it work. But if you've got a huge portfolio and you're tapped out and then you try to go ultra aggressive like that, it might not go in your favor. But I think the key there would be, maybe just a smaller purchase price
Slightly smaller purchase price
with the residential side, because then you just go back to that strategy of holding the residential, looking to sell those and generate a large deposit so that when you do go commercial, you've got those big deposits, but then you only really need to borrow 60, 50%, you know, and then you've got more options, better rates, and yeah.
Makes sense to me. And so from that perspective, that just shows for everyone watching or listening in, like with commercial property, it's a lot more flexible in super than it has been in the past as a policy there for 80% loan to value ratios. Secondly, residential property gives you a bit of the back of the napkin numbers of certain funds balances, purchase prices there. But 90% LMI waivers, risk-free waivers, that's a big game changer in the SMSF space. It definitely offers, because like the whole part of SMSF, the first word is self. So when you're self-managing, like to me, it's like you want to do more things with your money. You want to have more choices. You want to explore more assets. You want to explore. If you now have 90% loans and you can service it, your rents and contributions are able to cover the shortfall, you feel comfortable with it, your household income's high enough, that just means there's more money in your pocket that you can go and use other assets in. And to me, like from a super perspective, you're diversifying, whether it's shares, whether it's, you know, speaking of other assets, one person probably listened to this podcast here today, he made a killing with silver. And like just crushed. Like I have no clue about how that material side goes in terms of like that stuff, but I'm talking like 6 to 8x in the last few years. Wild, right? And his super balance, why I asked you that question's around $1 million now. Oh, yeah. And so he's probably listened to this podcast going,
give us a call, mate.
Commercial time. Maybe it's something what we do. But no, I think the main thing is like just those policies, they're game changers, just those shifts. And if you don't know lending and you don't have that understood, you might be in the vehicle that's self-managed. You might have the desires right to buy property, but if you don't get the right guidance, the right understanding, your money won't go as far as it could. So, Jack, when it comes to people reaching out to you and your team around everything to do with self-managed super funds, how can they get in touch? Yeah,
so just Google fouracrefinancial.com.au. You can book a link with the team there.
Perfect. Awesome. Well, that's another episode of The Property Nerds, and we're getting nerdier than ever in some of our recent episodes with the whiteboards out, talking through all the numbers, and just going into more detail about what's possible. If you haven't already caught the last episode where we go into the numbers like this, we covered off LMI, and maybe it was an episode or two ago, but the main thing is the last whiteboard special where we went into LMI waivers, the type of professions, today going into the world of super. So the key theme of all these episodes are two things. Like number one is there is so much intricate lending knowledge that if you get equipped with and you have a right team around you helping you with, and your team is not telling you that, but you want to know about these things, well, surround yourself with the right lending team, because if you get that right, you can really take your portfolio to new heights, especially with things like which professions get LMI waivers, which loans and which scenarios make sense go to 97% loans, not saving away for ages to even get into the market or get into the next place. Which times that you can get from the income to lending ratios for your super purchases residentially, and when you can get into commercial and what type of service you can get. If you're not constantly having these back and forth chats with your current broker, or they're not educating you on all these things, then they're loan processing, not investment strategizing. And not all brokers are built the same. And there's a reason why Jack and I are on these chats together, is because I just know from seeing our clients purchase over $1.43 billion worth of real estate, the common difference is that they didn't just attack it from each purchase one at a time, if they could borrow, if they could not. Everything was strategy, everything was all the possibilities, and then reverse engineering their goal, and then getting to the next purchases was just a piece of cake. So the main thing is, on finance, get yourself with the right team, fouracrefinancial.com.au, and we're going to see more episodes like this. Keep them coming so we can get more technical with finance and get you that next level of growth, because it will unlock not only your next purchase, but the buffers, the cash flow, the management, the holding. Because if you can hold for a long time, Australian property is very forgiving. So tune into the next episode of Property Nerds. Take care.
Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.